So the fourth objective is using CVP method to perform sensitivity analysis. Okay. So why do we need sensitivity analysis? We want to understand, as a managers, we want to understand how our price fluctuates and what does it depend on. So all sorts of understanding from the manager, why can that happen? But what we are really interested in is how can we predict how certain change affects our profit. So it can be what? It can be sales and prices, it can be cost, it can be, again, volume, right, that affects the profit. So in fact, your sensitivity analysis is something like an what if question. Okay, what if something happens, then what? So we want to have all the answers before that happens so that we can mitigate the risk. All right. So sensitivity analysis allows managers not only see how a small change affects the profit, but also how a strategy that we are deciding on, and maybe we decided, can affect our profit. So change in selling price, change in variable cost, and change in fixed cost. Thank you. Okay. So let's look at this example. If we have a lower sale price, how is it going to affect the break-even point? We went over the break-even point last class, right? So let's look. Again, we remember that with break-even point, when we're calculating it, our operating income is 0, right? So we have the same formula that we've worked for a couple classes already with. Sales revenue minus variable cost minus fixed cost is our operating income. So let's see if something changes, what happens. So we have $180 per unit, right? That's our sales revenue, how we calculate. And we also have variable cost that we identified at $80 multiplied by units sold, right? And we also found that our fixed cost is $12,000. That's the same problem about the events, right? Our operating income is again stated as 0. Okay, so what if scenario is, we said the sensitivity analysis. So let's look close. What's happening here? Again, we're trying to isolate the units sold so that we can find the number of events. We took units sold out. We calculated it's 100 multiplied by units sold. We moved our fixed cost to the right. That's 12,000, right? We've gone over this. So we calculated our units sold as 120 events. So with the original price of 200 sales events, our Greg's Tunes, I believe, break-even point was 100 events, right? I hope you remember this. So break-even was 100 events. Now with the new cost, that's new price that's lower, it's 180, right? What's going to happen? The break-even point moves to 120 events. So before we had 100, now we have 120. So just from this example, we can see that we can try to derive two statements. First is that lower price yields higher unit sales to break even, and higher price yields lower unit sales to break even. Okay, so what does it mean? It means that lower sale price, practically stating that each event contributes less, right, toward our fixed cost. So let's go over these two in more detail. So now we're increasing our cost, right? How will increased cost affect the break-even point? So again, we are calculating the same thing, right? The only thing, look what happens. Our sales price is $200, variable cost is 120, right? So we have $80 in units sold And again, 12,000 to the right. So now we have 150 events. Okay? So this is true for situation like economic downturn. That's something that would happen a couple years ago, right, when we had economic downturn. All right, well, still or not, but that's not the question of this class. So let's see. Again, higher cost yield higher unit sales to break even, and lower cost yield lower unit sales to break even. So increase in cost, right, that's what's happening right now. Our cost, just to let you see this, do you see how our variable cost is, it was 80, right now it's 120, but our sale is also, sale price increased, right? So what this is practically showing you is that increase in cost is going to raise the break-even point, okay? And the decrease in variable cost would have an opposite effect. So look at this. Do you see a difference between when we look at the example, you'll see that variable cost and fixed cost has a bit of a different effect. So let's look at the just fixed cost. How will the increase in fixed cost affect the break-even point? So here is a different story. We have higher fixed costs that yield higher unit sales to break even, and lower fixed cost is going to yield lower unit sales to break even. Do you see how here higher cost yields higher unit sales, right? So make sure you understand this difference. So fixed cost and just the cost, we're going to just split it right now and go through both cases. So right now we have $200 per sale, and we have variable cost at 80, right? We calculate the same way, but fixed cost right now is 15,000. Okay, that's the major difference here. So we calculate the same way as we usually do. We have $120 multiplied by units sold, and we move our fixed cost to the right, and here we go. We calculate our break-even point to 125 events. Okay? So your higher fixed cost yields higher unit sales for break-even. Okay. So this is just for you to, we've just calculated a number of things, and it's not quite clear right away from just the examples. So let's look at this and try to capture what's the difference of the effect. So if we have a change in sales price per unit, it's gonna, if the price goes up, the contribution margin per unit is also going to go up, but the break-even point is going to decrease. All right, and it's the opposite effect. When it's decreasing, it's going to decrease the cost margin per unit, and it will increase the break-even point. So what I want you to notice here is that the effect on contribution margin per unit is opposite to the result for the break-even point. So it's an inverse relationship between the contribution margin per unit and the break-even point. So the same goes for the variable cost per unit and for the total fixed cost. Okay, it's again the inverse relationship. Okay. What is a margin of safety? Margin of safety is your excess of expected sales over break-even sales. To calculate your margin of safety in units, we need to have expected sales. We'll subtract our break-even sales that we know already how to calculate before, and we get this margin of safety in units. So it's in fact your margin of safety in units. It's like a cushion, okay? That's also we can say a drop in sales that we can absorb. The company can absorb without incurring any losses. How can managers use this cushion? How do you think? It's usually to evaluate the risk, right? It can be used to evaluate the risk of current operations or to evaluate the risk of the future operations for the strategy that was chosen. And then we also have margin of safety in dollars. Okay, so we can calculate in units, but we also can calculate in dollars. And your margin safety in dollars is going to use this margin safety in units that we just learned how to calculate. Then we multiply it by the sales price, and we get margin of safety in dollars. So if you can look at this, just from the theoretical standpoint, your margin of safety focuses very much on the sales part, right? All right. Sure. So I'll go over the exercise with you and explain to you how to calculate in detail, and then we'll try one out. Got it? So Story Park competes with Splash World by providing a variety of rides. That's 19.7. Story sells tickets at $50 per person as a one-day entrance fee. Variable cost at $10 per person and fixed cost $240,000 per month. So they ask, suppose Story Park cuts its tickets price. Okay, so what do we have here? We have a decrease in price from 50 to 40 to increase the number of tickets sold. That's their strategy. They think that if they decrease the price, more tickets are going to be sold, right? Compute the new break-even point in tickets and in sales dollars. So here's what I did. We're going to use this formula. Again, we've done this, right? So sales revenue minus variable cost minus fixed cost is our operating income. So again, we split the formula, our sales revenue and sales price per unit, units sold, and then variable cost per unit, units sold, right? Minus fixed cost is our operating income. So as an operating income, we put a 0. Fixed cost, we were told it's $240 per month, right? But here what we do, we're putting our sale price per unit as 40, right? Ticket price was changed from 50 to 40, so we're going to put $40 here, units sold, and we'll subtract our variable cost per unit, which is what? Variable cost is $10 per unit, so you put $10 here, units sold, minus your fixed cost is a 0. So right now I'm going to take my units sold out, and I'm going to have $40 minus 10 multiplied by units sold, right? And I move my 240 to the right. Now all I'm going to do is just compute units sold. It's 240 divided by 30, and it's 8,000 tickets. So what is it telling me? That at new price I need to sell at least 8,000 tickets, right? Now I need to break even, that's in tickets, right? That's the first part, break even point in tickets. Is this clear? So now the new thing, right? The last slide, we kind of did that many times. This is something new. Now we're going to calculate the break even in sales, in dollars, right? So first, we'll calculate contribution margin ratio. This is different from your book, so it's more like in my lab. So pay attention to this. Contribution margin ratio is your contribution margin per unit divided by sale price per unit. So we know it's $40 minus 10, right? That's new price, variable cost. That's our contribution margin per unit. And I'm also going to divide it by sales price per unit, which is $40. So I found my contribution margin ratio is 0.75. The next step that you're going to make is take use the formula for break-even sales in dollars, which is fixed costs plus operating income divided by contribution margin ratio. So you make two calculations to find your break-even sales in dollars. So it's 240,000, operating income is 0, divided by 0.75. And so we found our break-even sales in dollars as 320,000. Makes sense? All right. So try this on your own. Now we're not going to use, so you see it's even saying requirement 1. It's very similar to what you have. Yes? Sure. Yeah? Okay, so we have the same story, same Splash World, same prices. The only thing that's going to change, we will assume that Story Park increases the variable cost. So what we're going to calculate with is the change in variable cost. So it's a little bit different, but still very similar strategy. Change in variable cost from 10 to 20 per ticket, and we'll compute the new break-even point in tickets and in sales dollars. So try that for 5 minutes. All right? And then I'll go over and we'll see what is it that was not clear on the other slide. I didn't print this. Try. It should be very similar, but it's not the same. Right? Can you do it? Did you get any numbers? Yeah? I did it yesterday, slapped it on the PowerPoint, but I didn't print it. I think it's right, but I need to check it with you guys. I think it's, yeah. I think it was 400,000. Who else got it? I mean, I can display it, but I wanted you to try first. All right? Okay. So interestingly, right, the calculation is different, right? We have $50 for a sale price per unit. We have variable cost that's $20, but we still got 8,000 units, right? Because it's the same difference gave us the same as 40 minus 10 and 50 minus 20 is still 30. So you did get the same number of tickets. Calculations are the same here. Yeah, you're right. I thought so. Okay, so now we're going to look at the contribution margin ratio. Same formula. We're subtracting 20 from 50, right? We divided, got 0.60. Now fixed cost plus operating income divided by contribution margin ratio is 400,000. And the reason why we got it different because our contribution margin is 0.6, and I think it was 0.75 before. Right? So our break-even sales are higher. Could you do this? Is it clear how you calculate this? Yeah? So that table was big and there was a lot of written there, but when you're doing the exercise, you just put where it needs to go, and then you can derive this. It's the same formula no matter what change it is. Yes?
What number do you divide it by? What number do you divide your break-even number in dollars to find units sold? Like,
What?
okay, your break-even sales in dollars is 400,000. So in order to find the units sold, like how much you need to...
You do this first, right?
Yeah,
You do this first as a first step,
yeah.
okay? And then you do that as a second step. So first you calculate your break-even units, and that's how you get the units, right? You're going to use this formula. The next step that you're going to take is you will use the contribution margin ratio to calculate your break-even sales in dollars. Yeah? Clear? Okay. So 19.9 is the other one that I wanted to go over. So here we're going to compute again margin of safety. Yeah, we just went over theory what margin of safety is. Story Park competes with Splash World, same story, by providing a variety of rides. Story sells tickets at $50 per person, 1-day entrance fee, variable cost is 10, fixed cost $240, same story. The only thing that I wanted to add that was missing here is the break-even sales are 6,000. I'm just going to give it to you. So if Story Park expects to sell 6,200 tickets, we want to compute the margin of safety in tickets and in sales dollars. Okay? Yeah, margin of safety in dollars is going to be 200 units multiplied by sales price. And that's going to be $10,000. Okay, so it's very easy to calculate your margin of safety.
The break-even sales are always multiplied.
Well, in this case, I gave it to you. But if you need to calculate them, you know how, right? We just calculated them before with that huge formula. Okay? So all you're going to do, you'll subtract expected sales. You'll take expected sales minus break-even sales. You'll get margin of safety in units. And then you'll take that margin of safety in units and multiply it by the sales price. Guys, can you not talk, please, during the class? And that's your margin of safety in dollars. Okay. So let's go over the fifth one. This one is a bit more complicated. So obviously when we have just one product, one price, great. But that's not real world. We always have multiple product lines, services, whatnot. So for that, we're going to take a couple steps to calculate the break-even sales in units first. Let's learn that. So when we have multiple product lines and skipped one, sorry. Like I said, most companies are going to have more than one product. And so selling price and variable costs are going to differ from one to another. And we need to account for that. So we will have different contribution of profits to profits because we have several product lines. So what we're going to do, we are going to learn how to calculate accounting for multiple products lines. So to calculate your break-even point for each of the product, we first are going to calculate weighted average contribution margin. And then we'll also learn what is the sales mix and how sales mix is going to help us to identify the weights for the total product sales. Okay? So obviously the whole thing is 100 and then some some are going to have portions. Okay, so what are the steps? First, we calculate the weighted average contribution margin per unit, then the break-even point in units for the package of products, right, for that number of products together. And then we'll calculate the break-even point in units for each product. And then what we're going to do, we'll multiply that bundle, that package, break-even point in units, by each product's proportion, right, of the sales mix. Okay? So the best is to look at the example. What does it mean? So let's do step 1. What do we know here? We have this company, Cool Cat, they call it. It's producing cat beds and scratching posts. So we have 2 products. All right? What we also know is that total fixed cost is $40,000 for this company. Now the sale price per unit is $44 for cat beds and scratching posts is $100. And then we also have a difference in variable cost for the both products. One is $24 and the other one is $30. All right, so what we want to calculate right now is the weighted average contribution margin per unit. So here's what we're going to do. We have contribution margin per unit that we want to calculate for each of the products. So cat beds is a 20 and scratching post is a 70. And how we got it? We took sales price per unit and we subtracted variable cost per unit. And that's how we got our contribution margin per unit. We also have a number of different units in the mix. So we have 3 in cat bed and scratching post is a 2. So what we're going to do, we'll multiply the contribution margin per unit by the sales mix in units. And that's how we're going to get our contribution margin. All right? So the total is going to be $200. I took $60 and I added $140. Now what am I going to do? I'm going to go back to sales mix in units and I will sum up those units that were for cat beds and the scratching posts that were identified there, right? So I'll take a 3 and I'll add a 2. So to calculate my weighted average contribution margin per unit, I'll take my contribution margin, total contribution margin of 200, and I'll divide it by sales mix in units. And that would be your weighted average contribution margin per unit, or $40 here. All right. Huh? Don't worry about it right now. We said that the fixed cost is $40,000, but let's move next. You'll see that. Here, you see? All right. So great. We calculated. Nice. Now we need to learn how do we calculate the break-even point in units for that bundle, right? 3 of one unit, 2 of the other one. What do I do? So I have this formula that we kind of know. It's just a little different. Break-even sales in total units is fixed cost plus operating income divided by weighted average contribution margin per unit. So I'm going to take that fixed cost that I just told you about, that is $40,000. My operating income, I'm calculating break-even point. It's a 0. So $40,000 divided by that $40 that I just found here, right? My weighted average contribution margin per unit. So I have 1,000 items. What is the 1,000 items? That's my break-even point in units for that bundle. Okay? Does it matter if it's all cats, posts, or what is it, beds? Right? It doesn't. It's just 1,000 items. We're not doing that yet. That's next steps. Huh?
1,000 of any item or 1,000 of...
It's your bundle. So that bundle is going to include some number of cat beds and some number of whatever posts, right? Posts, yes. Right? That's your next step. So now that you have all these wonderful items, you want to understand, so what is the portion one versus the other? So here's what you're going to do. For each of the products, to calculate the break-even point in units, we're going to do several steps. First, we'll multiply that package, break-even point in unit, by each product. Okay? So how I'm going to use this? I can't just say, okay, it's a 3 units of what? Cat posts? Oh, cat beds, right? I have to take a portion. So how do I know what the portion is? I know from here that sales mix in units was 3 for cat beds and 2 for scratching posts. And I know that the total was 5. So I'm just going to use that information to figure out what is the proportion. So for cat beds, it's 3/5. And for scratching posts, it's 2/5. So that's how you will calculate the break-even sales for each product in that bundle. So for break-even sales of cat beds, you have 600 cat beds. And for break-even sales of scratching posts, it's 400. And we got it by multiplying 1,000 by 3/5 or 1,000 by 2/5. All right? But that's not it. So the next one, we need to calculate total sales revenue for each of that product in the bundle. So I'm going to take the number of items, the number of items from here, so 600, right? And I know that the selling price is $44. Do you know where I got the 44 from? That's right here, right? Sales price per unit. It's given to you. So I'll take 600 cat beds and I'll multiply it by a selling price of $44. And trusting this number, that's 26,400. Yeah, that's correct. And then 400 scratching posts, that's 100 selling price is a 40,000. So how do I find my total sales revenue for that bundle? I sum those two up. Okay? Many steps, but they're logical and we'll practice. So does it make sense? Let's look. We're going to prepare this, call it contribution margin income statement. So what do we have here? We have sales revenue, variable costs, contribution margin, fixed costs, and operating income. Okay? Just like your income statement. But now look here. We divided our table into two additional, we added 2 additional columns for each of the products. So for cat beds, we just figured out it's $26,400 in sales revenue. And for scratching posts, it's $40,000. So we found a total of $66,400 just a slide ago. And we also are going to put our variable cost. For cat bed, it's $14,400, and for scratching posts, it's $12,000. And that's also something that we had on in the table in the very beginning, right? That's also something given to you. So the total variable cost is $26,400. And then we also know the contribution margin, $12,028. Did I explain to you this? Okay, how do we know that contribution margin for cat beds is $12,000 and for post $28,000? Any idea? Huh? Okay, good. Didn't go over separate with this, but that's we've gone through this before, right? Okay, so we know it's 40,000. The fixed cost is 40,000. That was given to us, and so our operating income is a 0, and that's true for the break even. Okay. All right. So let's I'm going to let you do this on your own. It's not difficult. Wet Weekend Swim Park sells individual and family tickets, which includes a meal, free beverages, and unlimited use of the swimming pools. Wet Weekend has the following ticket prices and variable costs. So you have for individual and you have for family for the sale price and the variable cost. So you have three things to do. Compute the weighted average contribution margin per ticket, calculate the total number of tickets that they must sell to break even, and calculate the number of individual tickets and the number of family tickets the company must sell to break even. Okay? So do that, and I want to see how you're doing. Hmm? Yeah, I've seen that. That's crazy. Yeah, I'm on the microphone. I'm just going to leave it here. show you because many of them of you are done. So here's the answer. Hold on, give me a second. So we have a question about the sales mix in units, right? That's this. We sell two, oh, I'm sorry. We sell two, where is that? Two individual tickets for every floor. Yeah? I didn't read this out because sneak it that way. Sorry. Okay, so let's look how do we calculate sales price per ticket, 30.90, variable cost 15.60. So contribution margin per unit is the difference of those two, and then sales mix in units we know. So yes. Oh, I'm so sorry. And then, yeah, that's why I'm standing here. That's why we have contribution margin as a 30, right? 15 to 30, 34, 120. Then we add it all up, we got 150. Got it? Weighted average contribution margin, 25. Yeah? Makes sense?
The contribution margin is 150. And how do you get 25? You divide it by the total number.
Right? Per unit. So I'm going to take my units, I'll divide contribution margin by units, and I'll get contribution margin per unit.
So can you give us another problem with that?
Sure. Yeah. This. Okay? Yes.
Do you mind if we simplify the 2 and 4 instead of 2 or 4, 1 over 2?
No, it's the same thing, right? Yeah.
You can keep going down, right? No matter how many products, just keep going the same way. Like this, so it was 5 products, so you just keep going.
What do you mean?
Like if it was 2 individual tickets, 4 family tickets, and then they had another package, you just keep going.
Yeah. Each bundle is the same. Yeah, each bundle is the same.
So we're always going to
Guys, I keep just talking over you. Who is talking in the right corner? Seriously, yeah.
So you're always going to give us, like we always get the sales unit, right? The sales mix. That usually comes with a problem.
These two are usually given. This is usually given. Yeah, it will identify. So what is a bundle, right? Because yeah. Sorry, someone raised the hand. Yeah.
Actually, I apologize. I'm trying to.
No problem.
That's why I'm a little loud.
No, it's okay. It's okay. All right. Oh, what am I doing? So we computed the weighted average. Now the next part, right? That's not it. The next one, we're gonna calculate the total number of tickets, right? So we'll keep this table here, but let's calculate the total number of tickets what we can must sell to break even. What are we gonna do?
So is it just the fixed cost divided by the 25?
And what is this fixed cost?
75,000.
That's right. Good job. And then calculate the number of individual tickets and the number of family tickets the company must sell to break even. So we have something for individual and something for family. We're going to have two calculations, right? We'll take that number and we'll use the number of that particular product in the bundle, right? So it's going to look like this. You're right. It's 3,000 total tickets multiplied by 2 over 6 or 4 over 6 for family.
Wait, so what is the 2 over 6 and the 4 over 6 simplified? Like what is that?
What is 2 over 6? That's right here, right? It's 2 sales mix in units over 6 total units. Right? That's your portion.
So you always take the
Uh-huh. Yeah. Okay. So I'm sure you have those in the homework. If not, email me, I'll give you one. Distinguish, let's do the sixth one. Very quick, and then a quiz, and hopefully we have time for a little bit of the exam. Distinguish between variable cost and absorption costing. You can look at this at my accounting lab. Actually, I wanted to also emphasize that in my accounting lab, there's a lot of media that shows you like cartoons on the subject. You can use those. It's pretty cool. It's very visual. Huh? When you go to the media section, you have to select the chapter and then what exactly you're looking for. So all your PDF slides are there, everything is there, and no, it's not going to say cartoons. I'm calling it a cartoon. It's like a video. But it's... I can show you the snapshots. If you email me, I'll email you the snapshots. But it's under the media, and that's where all your PowerPoints as well. And there's an audio PowerPoint and whatnot. There's so much resource. I think it's under students' resources. That's probably under the under your tabs. Right? Okay. Okay, so let's learn how do we distinguish between variable costing and absorption costing. Very short, very brief, but I want you to have this concept. So absorption costing primarily differs from variable costing in that the absorption costing considers fixed manufacturing cost as your inventoriable product cost, okay? Not this period cost, because your variable costing considers fixed manufacturing cost as period costs or expenses, right? So quickly here, we have, we know we have different types of costs, and then we have variable costing and absorption costing. So how does it differ? So in our product cost, we have what for absorption costing? Direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. That is not present in the variable cost costing system. For period cost, our fixed manufacturing overhead is right here. We discussed some of it in last 3 chapters that we had on the exam. So period cost is your fixed manufacturing overhead for the variable costing. And then the difference obviously is going to be for your income statement format, because for absorption costing it's just your conventional income statement, but for variable it's a contribution margin income statement. That's what we've been doing, right? We've gone over the contribution margin income statement today. So it's going to look different. It's going to have your contribution margin there.